How can we tell if a stock is trading at a fair price, if it's very cheap, or if it's overpriced? The P/E ratio is one of the most commonly used metrics among investors to know this. And in this video, we're going to cover everything you need to know about it and explain you why a stock worth $100 can be cheaper or more valuable than a stock worth $50. So let's get into it. The P/E ratio is a ratio that compares the price of the stock with the earnings the company has. This way, you're able to know if you're paying too much for a company that doesn't generate that much profits, or if you're paying a fair price as the company generates enough earnings to justify the stock price. The higher the P/E ratio is, the more you pay for the stock relative to the earnings the company has, and the lower it is, the less you pay for the stock compared to their earnings. You can think about the P/E ratio as this gap between their earnings and their share price. So theoretically, the closer they are to one another, the lower the P/E ratio will be. And the more apart they are from each other, the higher the P/E ratio. So what is considered a low P/E ratio? And should we just look for companies that have very low P/E ratios and that would guarantee us they're a good investment? Well, not really. Warren Buffett tends to have a preference for P/E ratios of around 15. What this number means is that by buying a share in the business, you're willing to pay 15 times the company's earnings, or that you're willing to pay $15 per each dollar of earnings they have. Let's give an example for you to see it more clearly. You can see it from a general perspective using market cap, which is the value of all the company's shares together divided by the company's total earnings. So, if the market cap is $2,250,000 and the total earnings this year were $150,000, the P/E ratio will be 15. If you multiply 15 by this number, the result will be the market cap. So you're paying 15 times the company's earnings. You can also see it from a per share perspective. In that case, we need to calculate their earnings per share, which is very simple. Let's use the same example, but instead of the market cap, let's focus on their share price, which is $225. And they have 10,000 outstanding shares, which is why their market cap was $2,250,000. Now, if the total earnings were $150,000 and the outstanding shares, so the total amount of shares they have available to the public are 10,000, then their earnings per share is 15. So now we divide it with the stock price to get our P/E ratio, and we get the same result as the previous example of 15. So you're paying 15 times the earnings per share for the stock, or you're valuing each dollar of profits at $15. If instead, a business is trading at $200 a share, has 100,000 outstanding shares, and their earnings this year were $500,000, the earnings per share for this business will be $5. And therefore, their P/E ratio is 40. So you're paying up to 40 times their earnings per share, or you're valuing each dollar of profits at $40. So as you can see, it's a much higher PE. And to your surprise, in the current market, you can find companies with P/E ratios up to $100. So investors are willing to pay up to 100 times their earnings for the stock. Two of the most popular investing strategies are value investing and growth investing. Value investing focuses on stocks that are undervalued or trading at a very low price and might represent a good investment to get in and take advantage of the discounted price. Growth investing focuses on companies that are believed to perform well in the future, and investors have very high expectations about their returns. For example, if Apple announces a new iPhone to be released soon, this might raise the expectations of a lot of investors. So if people start to massively buy Apple stock, this is going to bump the price of their shares, while earnings remain the same. Therefore, their P/E ratio will be higher and higher, because investors are willing to pay up to 20 or 30 times their current earnings, as they believe the company will perform very good in the future after the release of the new product. On the flip side, a company can miss estimations, as it happens quite often. You might have heard news about a certain company not meeting Wall Street earnings estimations, and this usually scares investors and drives them to massively sell the shares. which creates the opposite effect by reducing the share price, making the gap between their earnings and their stock price smaller and smaller, therefore decreasing their PE ratio. Now, the challenge we have as investors is to be able to differentiate if a company with a high PE ratio is a good opportunity for growth investing or if the company is actually overvalued, and if a company with very low PE ratio is a good opportunity for value investing, so it's a good company trading at a very low price because investors overreacted, or if the consensus is right about selling it and it's a business that is not undervalued but it's just not a good investment to make. So for that reason, a high PE ratio could be good if a business is innovating and is way ahead of their competition, or it could be a red flag as the business might actually be overvalued and investors are just buying wildly. And a low PE ratio could be a good thing if it's a good business trading at a discount, or a bad thing if it's a business that is actually not worth it and investors are right about selling it. Identifying if it's a good or a bad thing for each case is based upon our research. But one principle that I like to keep in mind when reviewing the PE ratio is that it is a good reflection of the emotions of the investors and the consensus feeling towards that company. And the truth is that most investors are actually very influenced and led by their emotions. So if you control them and you only base on the facts, you could actually take advantage of the consensus emotional drive, as you can identify good opportunities at very low prices or avoid overhyped stocks and understand that not all that glitters is gold. There are two types of PE ratio: trailing PE ratio, which focuses on historical data, and forward PE ratio. Now, forward PE ratio is an estimate from a stock analyst of the PE ratio for the company based on their forecasted performance of their next 12 months. And to get to this estimate, they can study different things like past averages, projects the business has in the future and their impact in the business, to get to a prediction for future earnings per share the business will have, which are divided with the current price per share to get the forward PE ratio. Theoretically, if the forward PE ratio is higher than the trailing, so let's say trailing PE ratio is 15 and forward is 20, this means that in the futures, earnings might decrease according to analysts, making the stock more expensive. And if forward is lower than trailing, it means that analysts believe that earnings will increase in the future. However, even though this could be useful for your personal research and your own future forecast for the business, taking other points of view, it is still a forecast, so it's not accurate. When reviewing PE ratios, you can compare them with the same company historical data, so you can see the ratios they have had for the past 10 or 20 years, and you can also review it and compare it with other companies in the same industry and sector. And remember, not to focus only on which number is higher or lower, but the idea is that you are able to know why the PE ratio of the business has increased or decreased so much compared to the previous years, in case you're analyzing the past ratios of the same business. Or why other similar companies have a higher or lower PE ratio than yours when you're comparing it with their competitors. So at this point, we should be able to give a clear answer for the first question, as to why a stock worth $100 can be cheaper than a stock worth $50. If a car company stock is trading at $100 with a PE ratio of 20, but is a very innovative company with competent and experienced board, producing electric cars and adapting to new changes in their market, is compared to another car company worth $50 per share with a PE ratio of only 10, but constantly misses expectations, doesn't show any signs of growth or innovation, then the first option is more valuable and a better pick. I thank you for watching this video and hope it was valuable to you. Don't forget to subscribe if you want to get more content like this. See ya!